Hi, Professor Barati. I'd like to go over the case study number 3, the final case study for the class, and basically walk you through it and discuss some of the reporting that I'd like you to do. Here's a chance for you to take a quantitative class like strategic cost management and all this number crunching and turn some math into art. So what you're going to do is basically create maybe a one-page report, and you're going to basically role play this as an analyst or financial analyst that has to interpret this information. So the heavy lifting on the number crunching has been done for us. So let's walk through what we have here so you can get an understanding. This is a month-end report for June 2015 for this company called Best Company. And you've been presented from your senior cost accountant a summary of some high-level financial results. So unlike some of the variance analysis we've been doing in class, which is detailed like direct labor, direct materials, standard costs, and so on, it's been basically rolled up into a very condensed contribution margin statement with sales, actual sales versus budgeted sales. Variable costs, budgeted variable costs. Contribution margin, budgeted contribution margin. But behind these numbers that I'm showing you right here are the per unit details. So in other words, the average selling price per unit is $90.15, and we sold 76,840 of these units, which will equal 6,927,282. The average variable cost per unit is $61.03, times the same number of units or pieces gives you 4,689,861. Therefore, we have a contribution margin of $2,237,421, which is $29.12 per unit. Our contribution margin percent is 32.3%. On the budget side, we have a selling price per budget unit of $90.93. Think of this as our standard. Times a budgeted number of units, which is 68,195, gives us this total budget. Our variable cost per unit is $59.83 per budget, times the budgeted number of pieces gives us variable cost of $4,080,144. Again, our contribution margin is $2,121,109 at 34.2%. The staff accountant then created a flexible budget or an adjustment so that we can get our variances. So based on our formula for our price variance, actual price minus standard price times actual quantity gives us our variance. So in here is the calculation of actual price minus our budgeted price. So our price here is going to be 90.15 minus our budgeted of 90.93 times our actual quantity for sales. For the variable cost, it's the same thing, but you're using the variable components times actual. The quantity variance is the actual quantity minus the standard or budgeted quantity times standard or budgeted price. So to get this, we're basically taking our pieces, actual minus budgeted, times the standard. You're doing the same for the variable costs and the contribution margin. So in order to interpret this, you have to know your variance analysis. You have to know how to calculate your price variance. Again, actual quantity minus actual price minus standard or budgeted price times the actual quantity. And you have to know your quantity variance, which is actual quantity minus the budgeted quantity times the budgeted or standard price for each line item: the sales, the variable cost, the contribution margin. And that's basically how these are calculated. The flexible budget, basically, as we learned, is saying what would our budget look like based on our actuals. So our flexible budget in sales is going to be our budgeted price times actual. Our variable cost is going to be our budgeted variable cost times actual, and so on. So the flexible is basically what would our budget look like based on our actual volume, not the budgeted volume. Again, the 2,237,000 minus the 2,389,000 gives us the price. And from the flexible to the budget, 2,389,999 minus 2,121 gives us the quantity. Price plus the quantity variance equals total variance. Or simply, actual minus budget equals total variance. So basically, all the variance analysis that we've learned is embedded in this little matrix right here, this contribution margin, and all the details per unit are in here. So what I want you to do is a report for the month, as if you were reporting to a CEO or a CFO and so on, basically explaining your actual performance to budget, what the variance is, if it's favorable and unfavorable, and then drilling down to the big number, the variance here, and discussing why this net variance is favorable and unfavorable, what the components are. So you're going to say that net sales were higher than budget by $726,000. Net sales for the month was $6,927,282, compared to budget of $6,201,253, which was a net variance, favorable variance of $726,028 favorable. And you want to mention that what percent this favorable variance is to the total budget. And then from there, you want to explain the components of this variance. You might say something like the net variance of 726 is due to a favorable quantity variance of 786,125 and an unfavorable price variance of 60,097. Then what I want you to do is drill down into the components. The price variance was unfavorable by $60,097 due to the average selling price, unit price of $90.15 was 78 cents lower than the budget. The quantity variance was favorable by $786,000 due to the actual quantity of sales, 76,840, were greater than the budgeted quantity of 68,195 by 8,645 units. Do the same analysis for your variable costs. And do the same analysis for your contribution margin. So prepare for, this is basically an outline. Prepare for a report for the month and results to budget the following categories. Talk about the pieces sold to budget and the variance. The variance to budget, highlight if it's favorable or unfavorable, and the percent change to budget. Talk about the average sales price per unit, the variance to budget, highlight if the variance is favorable or unfavorable, and the percent change. Prepare a report for the month-end results for the same for the average variable cost per unit, the variance to budget, highlight if the variance is favorable and unfavorable, and the percent change. Then, talk about the average contribution margin per piece, which is right here. The variance to budget, whether it's favorable or unfavorable, and the percent change. Then go on and write and discuss in a nice outline to briefly discuss the sales performance in dollar terms to budget, the overall variance performance to budget by highlighting. Talk about what makes up that variance. The total variance in sales dollars to budget, favorable or unfavorable, based on the sales volume variance formula or the quantity. Explain the two variances that make up the total variance, the price and the quantity. Right here, price variance and quantity. Discuss what created the price variance and the quantity variance, which is given to you right here and right here in the quantity. So know your variance formulas and basically elaborate on them, talk about them. Do the same for the variable cost and the contribution margin. Drill down and explain what components are driving the overall variance to be favorable or unfavorable, whether it's a price variance or quantity variance or a combination. So again, this is an outline. It tells you to basically dissect the numbers, talk about the differences between actual and budget by each number, and the percent change to budget. Then talk about the dollar in dollar terms, the actual to budget, whether the variance is favorable, unfavorable, the percent to budget, change in budget, and drill down into the components that make up the price and quantity variances. So on the side, you want to have your variable calculations, your variance calculations for price and quantity. Insert your numbers into those equations and basically prepare a report and tell the viewer what is basically going on with this report. What is going on with the results. The point here is to get you to interpret information and to write quality reports and not so much spend time calculating. There'll be spreadsheets and software that does this for us. Okay? That's one of the reasons why cost accounting, to some degree, from a textbook standpoint, becomes a little dry and stale. What becomes fun and interesting is creating the financial analysis reports that you'll be doing. So rather than have you spend time crunching numbers, you can spend time creating a very valuable and informational report that gets to the heart of these results. So I hope that clarifies things for you and makes sense. Use this outline. And then 5 is really what the report is about. Down here is an example. Overall sales for July were $6.9 million compared to budget at $6.2. Sales exceeded budget by X dollars and X percent. The total variance to budget was favorable or unfavorable by the dollar amount. Talk about the percent over budget or under budget. Total variance due to a combination of unfavorable price variance of X, primarily due to higher average costs per piece to budget. Put those costs or those dollar amounts in here. Do the same for your sales, your variable costs, and your contribution margin. One page, create outlines, do bullets, encapsulate them in a frame like this if you want. Don't do mumbo jumbo. In other words, keep sales separate. Make a paragraph, then go to variable costs and go to contribution margin. Use outlines like this to make it so that the reader can distinguish that you're not mixing contribution margins with your variable costs discussion. So keep it clean, neat, concise. Good luck and thanks.